So we're really happy to be market makers for the HANetf products. And what I wanted to talk to you all today about is not just how to sort of execute ETFs. Many of you in the room have executed ETFs or are trading ETFs, but I wanted to sort of get some thought process going about how potentially we can vary your outlook on your execution and vary the strategy to your execution. So just to give a bit of an introduction, RBC is relatively new to the ETF space here in Europe. We set the desk up 2 years ago, but we offer a full service ETF trading experience. To that extent, we're lead market makers in various products, such as the HANetf products on screen. We offer agency execution, block risk pricing, facilitation, and also hybrid execution orders, which we'll get into. And we also offer some ETF advisory services. So we help you with the selection processes and offer some research on the ETF space. The desk is fully multi-asset, so we're trading in all asset classes: bonds, equities, currencies, commodities, and alternatives. And we work as an authorised participant with most of the major ETF providers in Europe. So, to that extent, we're covering most of the products out there. We're also members of most of the primary exchanges. We also offer electronic execution and algorithmic services, and a lot of our algorithms are now focused purely on ETFs themselves. And with the MiFID II changes that came in early last year, we now offer systematic internalisation of a lot of our flow that comes through the algorithms. So that means that you're getting inside of a screen spread whilst using our algorithms. We combine all the technology to, with our experience to provide a full service for you and deep liquidity. That's sort of a breakdown of the team. We have sort of members in Toronto, New York, and execution services in Sydney. So we not only execute European ETFs, but Canadian, US, and global ETFs. And also available, we do some research in the space. So in terms of the market space here, Europe is now, what you would say a more mature sort of market than what it was several years ago. It's now the second largest market for ETFs, just behind the US. And recently we did an analysis and saw that there was over 1 trillion in assets here. The number of listings is still fairly large. There's like 3,600 different ETFs traded across many different exchanges and currencies. So there still is an element of fragmentation to your executions here in Europe. But what we're finding more and more with the changes that occurred in MiFID again, the MiFID II sort of implementation, is that there's more and more trading that's going on exchange now. So Europe is now starting to take the lead that the United States had, and ETFs are not being just traded primarily OTC, but are being traded on exchanges and being printed. There was analysis done on this, and we saw a significant uptick in the amount of exchange prints after the MiFID II changes, upward of about 60%. And this was the block trading, risk pricing, OTC transactions that are now being forced to be printed on MTFs and on systematic internalizer exchanges. The other sort of thing of note here is the top 10 issuers under AUM has also done some changing around. There's been some consolidation in the industry. iShares is still a leader in the space, but we've had a prominence of WisdomTree and Invesco sort of entering into the top 10 through consolidation and the acquisition of the ETF Securities Commodities product by WisdomTree and the Source product by Invesco, and that sort of pit those two into the top 10 there. But more of a consolidation there and a more maturing process in terms of issuance. So all that leads to, fundamentally we have our execution process, which I'm not going to sort of go over this sort of, in great detail, but, in essence, for anyone who needs a reminding, in the ETF space, we have the exchange, buyers and sellers within that exchange, and we have the ETF market makers that provide liquidities into that process. and then the creation and redemption process with the ETF provider, which adds to that liquidity process. So essentially, the market maker can easily go into the pool of assets and create new ETF units, or can take them from them and redeem those units. And that provides liquidity and good tight tracking error and good tight markets to what we're trying to achieve. So the secondary market, as I'm sort of going to be proposing to you, the secondary market is becoming more and more mature, and there's less reliance on the primary market in the day-to-day transactions that are occurring in the European exchanges. So in terms of execution strategies available, I wanted to sort of go through a list of the possible strategies that clients are using now in the space. And we'll talk about these in a description, and then I want to sort of talk to you more about sort of how we can potentially implement them. In essence, we have probably the most popular execution point that we have is risk or single point of time execution. And this is normally when an ETF is executed either within the exchange bid and offer spread, and it's normally done against a market maker at a point in time. So a price is asked of that market maker, and the market maker makes the price, and it's known and it executes at that point in time. It's a very popular sort of method of transaction. Other types, we have sort of limit orders, so clients can place a limit price into the market, and if the ETF market on screen goes through that price or gets to that price, then again, market makers or other secondary orders will execute at that point in time as well. In addition to that, you have a variant of an Iceberg Order, which is when you might not show your full volume at that point. So you might have a portion of your full order in the market, and as that executes, it just reloads more orders at that point. So this is a very good sort of execution strategy for people who are a little bit more price sensitive. We have in line with volume. In the ETF world, in the equity world, in line with volume means you participate at a regular rate of volume with the market. So if the market trades 100,000 shares and you have a 15% inline volume order, you'll be executing, say, 15,000 shares for every 100,000 shares that goes through the exchange. In the ETF world, we have that type of order for the actual ETF itself, and we also look at inline volume in terms of working inline of the underlying volume. We're going to talk about that more, about how we sort of look at the underlying volume of an ETF to actually ascertain whether or not that ETF is liquid enough to transact. We have market on close orders. These are not to be confused with NAV orders, but essentially the ETF is listed on an exchange itself, and there is a closing auction process on that exchange normally in Europe. And this type of order, MOC, is when you actually execute on the exchange itself at the closing auction. A NAV order, on the other hand, is when you trade an ETF relative to its net asset value calculation. And the net asset value of an ETF is normally calculated at the closing price of its underlying assets, and it's a daily calculation that's done that allows the issuer to report the net asset value to the regulators and to the market and to benchmark things at that point. A lot of trading gets done at this point as well, and in that instance, we're not trading the ETF itself, but we're trading the underlying asset as a hedge to the process, and we trade relative to NAV. So you may purchase at 10 basis points over NAV, or you may sell at 3 basis points under. It's a relative to NAV transaction. Now, more importantly, the next 2 or 3 sort of strategies are strategies which are well adopted in the US trading market at the moment, but are being sort of ignored in the European market at this point. And this is sort of, these are the execution processes that I want to sort of talk more about today. We have VWAP, TWAP, and over-the-day style transactions. So in these instances, the ETF itself, the transaction isn't just done at a single point in time, but is spread over a period of time. And what this does is it increases the amount of time that you're executing over, but reduces the amount of point risk that you're taking. So think of it like, if I'm going to execute at a single point in time, do I actually know that that's the price that I want to execute at? Do I know that the market is going to be, moving into my favor or against me at a different, at 15 minutes after the execution has taken place? By spreading an order over time, a client can reduce the amount of point-in-time risk that they're taking on a transaction. And so we look at this in two ways. We look at the VWAP, TWAP over the day, which is the ETF itself being transacted over a period of time. Then we have a hybrid or an underlying transaction, which is also popular. And this is a very sort of similar variation, but it looks at executing the underlying assets over a period of time, and then there is an ETF price that is struck based off the execution of the underlying assets. So a market maker could turn around and say for a FTSE 100 ETF, rather than buying the ETF itself, I'm going to go and purchase the FTSE 100 basket for the client at this point in time, and then the basket is used as a pricing mechanism to then roll up into an ETF price. And so we can direct an order around the basket of the transaction as opposed to the ETF in the transaction. And it's one of the ways that you can actually sort of get at a lot more liquidity, and you can also, in a lot of instances, obtain more favourable pricing in the process as well, because the market maker is essentially not being asked to place a risk premium into the trade. And finally, one of the more obscure ones, but it is starting to become popular, especially in the fixed income space, is a pair trade or a relative trade. And what this does is, we have various listings of ETFs globally, and our clients sort of look at those ETFs and want to move between the different types of ETFs that may track the same underlying asset at any different point in time. So, for instance, if we have a client that's holding a dollar high yield bond ETF in one listing or one jurisdiction, and they'd like to move into a very similar ETF in another listing or another jurisdiction, one of the more successful ways to transact in that is to leave a relative limit order or a pair transaction with your broker, and they will execute based off a pair transaction, so that whenever the buy or sell transaction comes into sort of line or into limit or is favourable to the client, the execution is done at that point in time. It allows for a cost saving when moving between ETFs and moving in between jurisdictions. At this point in time in Europe, the most, as I sort of mentioned, the most popular forms of execution are single point in time executions and NAV executions. And the reason for that is we were dealing with sort of a relatively immature market, say 5 or 6 years ago, where clients were looking at the screen volumes, not seeing a lot of execution activity going on in the screens. There was a lot of executions going on outside of the screens. Probably about 60–70% of all executions in Europe 5 years ago were happening OTC and weren't being printed on exchange. We're now past that. MiFID II has now introduced printing into the exchanges. But also taking you back to that point in time, there wasn't as much on-screen, sort of smaller over-the-day activity in the ETFs. And as a result of that, spreads were fairly wide because market makers were the only sort of prices in the screen. And clients were being educated on the process that if you actually went to a group of market makers and put them into competition and asked them to trade on risk at a single point in time, that you could achieve better than the screen prices, and with more advantageous volume as well. So you could trade very large volume at a price sort of lower than the screen to get set in your position. Now, I'm not saying that that is a valid execution process and that's working fine, but now we're seeing more and more volume enter into the screen. We're now sort of, it should be within the client's sort of realm of thinking to sort of expand on their strategies when they go into execute, and maybe sort of dissipate some of the single point in time risk and start to look at other points of other points of execution, looking at price, looking at the relative market execution, as opposed to whether or not they're getting inside of the spread at a single point in time. The other sort of popular expression is NAV as well, because it's a very easy sort of process or trading process to describe to a client. It's fairly transparent. But the problem with NAV is that it will actually you're held to the closing price of the underlying asset. So if there's a more advantageous price for your ETF during the trading day, you can't take advantage of that. You have to wait for the net asset value price to be struck before you actually execute. So getting back to the ETF market itself and how things are changing in terms of liquidity, we obviously have the physical asset and the market makers that trade in that asset. And we saw that from the diagram earlier, market makers can make price around that asset price and then provide the liquidity to the ETF market itself. But what's now developing and the maturity of the market means that all of the different factors sort of coming into the market are now sort of applying more liquidity into the process. So, for instance, we have governments and central banks, derivative traders, retail investors, pension funds, hedge funds, long onlys, etc. All of these different client bases are now pushing liquidity into the market at different points, whether they're buying, whether they're selling, etc. More and more of these clients are starting to look at the screen and looking at it and saying, well, we're going to sort of apply our liquidity into the screen as opposed to going directly into a market making situation. That's a good thing. Like, we're all sort of now getting tighter spreads, better execution, and it's also, what we're saying is it's opening up more execution strategies so we can focus on whether or not we're getting a good price for the ETF itself and whether or not the execution is risky or not. On top of that, the development of the custodial banks into the lending scheme means that market makers don't necessarily have to go to the primary physical asset all of the time. They can sell ETFs and potentially borrow those ETFs and provide liquidity that way. A lot of the custodial banks are getting their act together, and again, that's providing more liquidity into the process. So measuring the liquidity is a combination of all of those factors. And when we look at liquidity from the underlying asset, the liquidity from the secondary market, as we just described, and liquidity from other things such as futures and listed derivatives, the three aspects of that come together to give you the true liquidity of the ETF. And with the maturity of the market, it's now becoming more inherent that you can take advantage of these three processes coming together. We also need to sort of think about the hidden costs of a transaction, etc. So at a single point in time execution, you're relying on the screen itself, the ETF screen itself, to be a fair value to the transaction itself. And what we sort of look at in terms of ETF execution, we often describe it as an iceberg, in that the tip of the iceberg is what you see as your costs. You might have your commissions, your taxes, or any sort of ticketing charges that you may be charged on your transaction. And they're costs that are tangible. You can see them. They're above the water, etc. But as with any iceberg, most of the transaction costs that you incur in a transaction are hidden below the depths and not as easy to analyse. And so when we talk about this, it could be the impact of the ETF and its relative price to the underlying. So if you ask a group of market makers for a risk price, and they are the screen they are making the screen price at that point in time. Are they fading their market? Are they changing their market relative to the price of the underlying asset? But more importantly, we've got other costs which, again, are very quite difficult to sort of quantify. And this is the opportunity cost. So if I wait and I don't trade, or if I take my time, or if I spread an order out, have I missed the opportunity to get in at a good price? Has the market moved away from me? And then on top of that, you have things like gap risk. And also, I would also say from opportunity costs, if I transact at a single point in time and the market falls away another sort of 2 or 3% from where I've transacted, have I missed the opportunity to maybe spread my order a little bit and sort of reduce that risk as well? And then finally, we have on-screen premiums and discounts as well. ETFs don't necessarily track their underlying asset, purely, and ETFs do enter into premiums and discounts for whatever reason. So capitalizing on whether or not an ETF is trading in a premium, like being able to sell it when it's in a premium or being able to buy it when it's in a discount, that lends itself to the pair and relative strategy that I sort of mentioned earlier. Doing that, you're sort of going to the broker and sort of asking them to trade, to sell your ETF when it's at a premium and to buy your ETF when it's at a discount. There are many different strategies that people can adopt in that process. So I wanted to give you some simple rules to sort of look at in terms of, to think about when you go into your ETF transaction. So we've talked a lot about strategy, and I'm not saying that one is better than the other. All I'm trying to say is that we should be thinking more broadly about like what strategy we adopt and not just going for one strategy. So here are a couple of simple rules that I would think about in terms of executing an ETF. Normally I would focus on the spread of the ETF itself and that spread relative to the underlying asset. So if the ETF spread is wide, that's fine, as long as the underlying asset spread is also equally as wide. Right? So if you're looking at something, you're saying, oh, it's a little bit wide there, but you know, we're dealing with maybe sort of emerging market bonds where the spreads are relatively wide themselves, then you can see that the ETF itself is probably displaying a good sort of process in transaction there as well. So in analysing an ETF, I often use sort of, you know, Bloomberg description pages. And here's the Sky ETF here, which is, was recently launched by HANetf, looking at cloud technology. And a couple of the key things that I'd look at here is the spread of the market up top. And then I would look to sort of see whether or not the underlying asset, you know, the spread of that ETF was actually matching the underlying asset itself. Various other things here is, you know, expense ratios, etc., but we won't go too far into that detail there. So based off that, I'd also focus on the implied liquidity of the ETF from its underlying as opposed to the ETF itself. So if we look at, you know, Sky, you can sort of look at the screen on Sky. At the moment, there hasn't been a lot of activity, maybe a few sort of retail trades here and there. You'd think to yourself, it's not a very liquid ETF, I shouldn't be getting involved in this trade, etc., or I have too many to buy, you know, how do I go about it? It's then that we sort of flip it on its head and we say, right, we're going to look at the underlying asset itself and see whether or not that's liquid. If the underlying asset itself is liquid, then I could probably easily obtain liquidity in the ETF itself via that. I could push the ETF and, you know, it wouldn't budge too far because there's an arbitrage opportunity for the market makers. So there's another cool function on on Bloomberg called ETFL, and it actually looks at the liquidity, the implied liquidity, based off the underlying asset itself. So looking at Sky, you can see that it's like 95% US listed equities. So, you know, we can analyze those fairly sort of readily. We've got 4% in China and thereabouts. So what this function does is it actually takes the underlying basket and it says, right, if you want to place a percentage limit on any of the underlying assets, then what liquidity would I achieve in the actual ETF itself? So they've sort of said, you know, to explain this sort of, you know, quite simply, is they're taking the most, you know, one of the biggest weighted shares. Well, it's Mobileye on here, not one of the biggest weighted, but one of the most illiquid sort of shares within the basket. So it's MOBL here. And it said, if I apply a 1% average, like if I look at the average daily volume of that underlying security, that share, and I apply a 1% limit on the amount of volume that I trade in that, then what does that transpire into the liquidity of the ETF itself? So we put a 1% trading limit on MOBL. It means then that we could potentially trade about $10 million of the ETF itself. So you go from looking at an ETF and saying nothing trades in the screen ever, to saying, well, if I looked at this as a basket trade and applied a very, very stringent liquidity constraint on the basket, the underlying basket, you know, how many ETFs could I buy for that? And it comes through that, you know, potentially we could buy sort of $10 million of this ETF very, very easily via the underlying basket. And so approaching a trade for $10 million in Sky is a cinch. You just, you know, you've got to follow a couple of other rules, but you know that you're getting the liquidity in that space. Very simple function to use. So that brings me to my next point. You want to try and execute when all of the underlyings are open as well. So in the case of this product here that's listed in London, you're going to get very, very good liquidity in it and very, very tight pricing if you execute in the last 2 hours of the day in London as well. So essentially, you know, when the US market is open, the underlying assets are open, the ETF will be liquid, and you can achieve a better price. So again, that gets back to that point there. It's 95% US. Another couple of key things: avoid the open. Like spreads are wide at the open. Spreads do silly things. The market makers are trying to sort of ascertain where the pricing of the market is. They widen their spreads. Try not to execute around that point. And try not to execute around economic releases as well, because a very similar thing happens. And then finally, utilize SI, systematic and internalizers. So essentially, our algorithms are set up so that we provide you an insight of spread price when you utilize an algorithm at RBC. So essentially, utilizing an algorithm or an execution platform that allows for systematic internalization and has a good group of ETF market makers associated with that will get you better prices as well. And then finally, reduce pin risk by spreading your execution over the day in some instances. Again, I talk to a lot of clients and we get single point in time executions with these guys. And I know I've been trading ETFs for about 18 years. I still can't tell what the market is going to do intraday most days. And I'd be very surprised if anyone in the room had that sort of pinned down like regularly. So we're going to get to some numbers about this in a sec, but like essentially that's another key point. And remember, use a range of strategies. Don't just stick to one. Not all the strategies work for one sort of system, and so vary your processes and keep lots of different strategies in the one in your bag of goodies to get executions done. Right. So finally, last couple of points. I know we've got time sort of coming up here, but one of the last points I wanted to make is, I did a comparison of ETF executions compared to our regular equity executions in the firm, and found some interesting numbers, which I sort of wanted to ask a question of everyone and just sort of see whether or not we could come to some conclusions here. But when I looked at the regular cash executions at RBC here in Europe over the last 3 months, I saw that like 28% of the orders were a single point in time or an active decision transaction. So the client has actually said, this is the point in time that I want to trade, and I'm going to trade at this level, etc. 72% of my basket flows, so this is regular baskets, not ETFs, 72% were passive. Spread over a period. I don't know what the price is going to be in 15 minutes' time. How about I execute it over the next 30 minutes or so? So when we actually looked at the ETF flow, it's the opposite. And funnily enough, 84% of all of the executions we were doing were single point in time active executions, whereas only 16% were clients saying, do you know what? We're taking too much risk executing this at one point. I'm going to spread the order a little bit and trying to sort of get some of the other aspects of the market going, such as liquidity and underlying liquidity, and etc. So the question is, why is this so? Well, I pointed to it earlier. The market was immature sort of 5 or 6 years ago. We had a lot of the providers were trying to educate our clients about how to best execute. And at that point in time, you could achieve a great execution by doing a single point in time execution, getting yourself set inside a spread, and sort of moving on from that. The market's much, much more mature now, and you're now obtaining that on a more systematic basis, either through the screen or through systematic internalizers. So, the point is, if you think that you're picking the market at right points and executing at single point in times, then fine, go ahead, keep using it. But what you're getting to at this point is you're getting more and more liquidity coming into screens and more advantageous executions by spreading your orders as well. So this is just, I've got 2 more slides, sorry Chase, I know you're there. But this is just a point in time. We took a snapshot of QQQ NASDAQs, and this was on Christmas Eve. And this is during the trading hours in the US, and I just want to alert you to the point that there's 2%, 2.5%, 3% swings in this particular ETF over periods of 1.5 hours and half an hour at a time. So this is very, very risky trading intraday, and your execution quality is going to be very, very low if you pick a single point in time to execute at this in this market, unless you are picking the lows of the day, which that's highly possible as well. So to that extent, we did some analysis. And this is the final slide here, guys. What we did is we looked at 4 ETFs in Europe, and we decided to say, right, if we took, 6 random execution points during the day, and we compared it to an over-the-day transaction, or a price that you would have achieved if you'd executed it over the day. And I got one of the guys on the desk to look at what the basis point standard deviation was if you'd executed at that point in time relative to several benchmarks, and those benchmarks being previous close, open, close, and also an over-the-day execution. So what we found is MSE, which is Lixor, it's a Eurostoxx 50 product. Well, sorry, what we found across the board, we did it with Eurostoxx 50, UCD, which is consumer discretionary it's a US consumer discretionary ETF listed in London, WLD, which is the Lixor MSCI World ETF, and then EMQQ, which is the HANetf product that's just been launched recently, which has China and EM sort of stocks within it. You can see all of the gold sort of the gold points that have sort of come up here. Every time that we looked at an execution over the day, by comparison to all of the benchmarks mentioned, we got lower standard deviation from those benchmarks by executing over the day rather than the random single point in time. In MSC, when everything is open and underlying, we had sort of relatively low numbers. But then something like EMQQ, which is sort of EM and has wider spreads, we had a lot of deviation from your benchmark price as you were executing at random points in the day at a single point in time. In each and every one of the cases, bar a few, you achieved optimal, a reduction in standard deviation or risk from your benchmark by executing over a period of time as opposed to a single point in time on the transaction itself. So if you've got any more questions about that graph, happy to discuss it further. But I hope that you sort of approach your ETF execution strategy in a different way. Try to broaden your horizon and speak to your broker as well about what inputs they can have on the process. So thank you.
Thanks, Matt. It's great insights there. I'm not sure, have we got time for any questions, Claire, or are we running one question to Claire? She's in charge. Anybody, quick question for Matt on the execution side? Looks like everyone's hungry. I had one real quick one, actually. It's totally, a little bit off topic. HANetf, we believe, ETFs, it's not just about being low-cost passive. We just think it's a better technology compared to the mutual funds. So we think a lot more mutual funds will convert to ETFs, or new funds will come out as ETFs. Do you think there's any limit in the market to how many funds? I mean, on one of your earlier slides, 3,600 ETFs out there. Do you think there's at what point does the market-making community start to strain under the number of ETFs, or do you think we can go to 5,000, 10,000 ETFs? Or?
We've definitely seen a consolidation of the Me Too product. So Europe was primarily a marketplace where you'd have 5 or 6 different Eurostoxx 50 products in the space. We've definitely seen a consolidation of that, and that's from the Wisdom Tree and Invesco, and that top 10 figure is actually consolidating. One of the key things that we are seeing in the market, and this is great. I come to work each day and try to sort of see cool stuff and whatnot. But ETFs for me now are becoming a story, and every ETF now is painting a story. And the way to describe it best is if you have an idea or something that's going to happen, and I use this point, if you said to yourself, right, 40% of the cars in London are going to be electric cars in 20 years' time, you can create an ETF that tells that story. And we're not investing in ETFs that are sector-driven so much anymore, or factor-driven, but we're investing in ETFs that are right up and down the supply chain of a story, or are doing something to that extent. And so EMQQ is a great example of that. Recently we had some really big sort of turmoil in the market with China tariffs and etc. EMQQ is a product that essentially is you're investing in the consumer, in the emerging market consumer, and you're also investing in the internet being the access point to that consumer market. So that in itself is painting a picture to an investment. And it's great that you've got an ETF that can just sit there and allows you the access to that picture and that story. So that's the exciting sort of development. And so to that extent, I think, you know, there is growth in the number of ETFs that are going to come along because, you know, people want to trade the story and there's more stories to be told.
Thank you very much, Matt.